You follow the traditional financial playbook. You work the hours, you skip the luxuries, and you save what you can. Yet, at the end of the month, the math feels tighter than it did a year ago, leaving you with the sense that you are falling behind despite doing everything right. On paper, the economy looks optimistic. Average salaries are projected to grow by 9.1% this year, while the government's official inflation rate is reported at a manageable 5 to 6%. That the macro data reveals a different reality. Household savings have plummeted from 11% to just 5.1%. You are paying a hidden, invisible tax that drains your accounts every single day. The trigger for this squeeze is global. Over a 5-month period, the price of a barrel of crude oil spiked 65%, moving from $65 to $109. Because India imports 88% of its crude oil requirements, we have no choice but to absorb these costs. This global price hike functions as an inescapable tax on every person in the country. However, when you look at the price boards at a local petrol station, the numbers often look frozen. This creates an illusion of stability, suggesting the global spike isn't reaching your pocket. That stability is artificial. To keep prices at the pump from rising, the government has cut excise taxes, which removes 1.5 lakh crore rupees from the national budget, money that would otherwise fund public services. You can find the true market price by looking at private retailers like Shell, who don't receive these government subsidies. Their petrol is priced roughly 25 rupees higher per liter than the subsidized rates. That 25 rupee gap represents a hidden debt. The government must recover this shortfall by raising future taxes or printing more money, further devaluing your currency. The true cost of oil travels far beyond the petrol pump. Because 70% of India's freight moves by road, every item in the supply chain is at the mercy of diesel prices. A simple increase in diesel costs adds 2 to 3 rupees per kilometer to transport expenses. This means a truck of tomatoes from Nashik or flour from Punjab becomes significantly more expensive the moment it starts moving. Companies know they can't keep raising prices without losing customers. Instead, they use shrinkflation, reducing the weight or volume of a product while keeping the price tag exactly the same. A 5-rupee biscuit pack shrinks from 100 to 75 grams. A soap bar cuts from 155 to 135. Visually, nothing changes, but with less product, you finish them faster, buying more units. This invisible shrinkflation costs households an extra 25,000 rupees annually. While the government's 5% inflation index is weighted toward basic staples like grain, a middle-class budget prioritizes education, essential healthcare services, and digital connectivity. These modern services rise in price much faster than basic food. Factoring these into your budget, your personal inflation rate is actually closer to 12%. If your costs are rising by 12%, while your salary only grows by 9%, your standard of living is actually declining. That raise is in real terms a pay cut. You can't control global oil prices, but you can change your defensive strategy. You can avoid the compounding hidden fees of delivery apps by buying staples in bulk from physical stores, which lowers your per-unit cost. You can also find significant savings in healthcare. Medicines at Jan Aushadhi Kendras are chemically identical to expensive brands, offering the same treatment for 13 rupees instead of 303 rupees. During times of economic anxiety, many people stop their systematic investment plans to save cash. This is a fundamental mistake in long-term wealth building. Market downturns are the specific periods when your fixed monthly investment buys a larger number of assets. By staying consistent, you lower your average purchase price over time. However, cutting costs has a limit. There is a floor to how little you can spend on food and housing. To truly overcome the squeeze, you have to move from defense to offense. While your expenses have a hard floor, there is no ceiling on your ability to earn. The most effective way to outpace inflation is to increase the value of your output. We saw this in the year 2000. Those who learned to build software during the early internet era generated significant wealth, decoupling their income from the broader economic stagnation. The current rise of artificial intelligence is the modern equivalent of that boom. It doesn't require you to be a programmer. Workers in fields from biology to the humanities can use these tools to improve the quality and speed of their work. Those who adopt these tools early will find they can accomplish more in less time, raising their income potential far beyond standard increments. Surviving this economic period requires more than just shrinking your lifestyle. You must move toward the evolving edges of the economy, building an income that grows faster than the invisible tax can take it away.